crowd. Thank you all for joining us. Also thank those who are joining us online through Zoom webinar. Just a few comments with regards to those joining us online before we get formally started here. There will be no voting. For those of you who are watching online, you cannot vote online. However, we have extended the meeting tonight, its formal closure till 10 p.m. So for those shareholders that are viewing online and would like to vote by ballot, you will be given an opportunity to request a ballot and then forward it back to us before 10 p.m. Also, there will be time for question and answers. There's a chat session that is going to be active. Jen Johnson, the bank's vice president, chief risk and operations officer, will be manning that and sharing questions as they come in, and we welcome those questions throughout the evening as well too. So again, thank you for joining us, and I'd like to introduce Rochelle Priestkin, our chairperson for the board.
Thank you,
Rochelle.
I would like to welcome all of you to the FNB Hartford Bancorp annual meeting. I am Rochelle Priestkin. I am the chairman of the board, and I would like to call this meeting to order. The first role is to call for a nomination and election of a chairperson and secretary for this evening's meeting.
I'll move for Rochelle Priestkin as chair and Doug Persich as secretary.
Motion by Ken Reiser. Seconded by Scott Lopez. All in favor?
Aye.
Opposed? Carried. In accordance of the corporation's bylaws, a majority of the outstanding shares of the corporation entitled to vote, represented in person or by proxy, shall constitute a quorum at a meeting of the shareholders. As of yesterday, Tuesday, March 21st, 2023 at 3 p.m., the corporation had received proxies constituting 353,446 shares and representing 81.07% of the shares outstanding. As such, I will declare that sufficient shares are represented either in person or by proxy to properly conduct this annual meeting. And now we will have the readings of the minutes of the March 2022 annual meeting by Doug Persich.
Here we go.
Chairman of the board, Rochelle R. Priestkin, called the annual meeting of FNB Hartford Bancorp Inc. to order at 10:04 a.m. 18 shareholders were represented in person and 5 shareholders were present via Zoom webinar functionality. First order of business was to elect a chairman and secretary for the meeting. Kenneth Reiser made a motion. Rochelle R. Priestkin act as the chairman and Timothy G. Perman to act as secretary. Motion seconded by Craig Wolf. Motion carried. Chairman Priestkin declared in accordance with the bylaws of the corporation, a majority of the outstanding shares of the corporation entitled to vote, represented in person or by proxy, shall constitute a quorum at a meeting of the shareholders. As of Tuesday, March 22nd, 2022 at 5 p.m., the corporation had received proxies representing 349,786 or 80% of the outstanding shares and declared sufficient shares are represented in person or by proxy to properly conduct this annual meeting. Timothy G. Perman read the minutes of the March 24th, 2021 annual meeting. There being no additions or corrections, Scott Lopez made a motion to approve the minutes as read. Mark Hauser seconded the motion. Motion carried. Timothy G. Perman presented the 2021 FNB Hartford Bancorp Inc. reports, which included year-end balance sheet, income and expense statement, and loan loss reserve. President Timothy G. Perman additionally provided information on loan and deposit growth history over the last 5 years. He also reported on delinquent and classified loan trends, non-performing asset to total asset ratios, and net charge-off to average loan history. A final analysis relating to the bank's consumer and business lending support throughout the COVID-19 pandemic was also highlighted. Consolidated income for 2021 was $3,478,000, reflecting a 25% improvement over 2020. This translated into a similar 25.8% improvement in earnings per share and an 11.69% return on investment. President Perman noted for shareholders that the most recent appraised value of the company's stock was $86 per share, a $13.50 increase over the December 2021 appraised value. President Perman complimented the Forte team for a great year. The strong performance in loan and deposit growth and investment center revenue were made possible by the collective efforts of all the bank's employees. Our team continued to manage the impact of lingering COVID-19 conditions, and he expressed his appreciation for their continued perseverance and dedication to maintaining a high level of service. President Perman announced the retirement of Lori A. Hilger, Vice President, Chief Financial Officer, on March 4th, 2022, and extended appreciation of her 19-year tenure with Forte Bank. Ms. Hilger managed the banking financial report, asset liability and interest rate risk, liquidity and funds management function, and has done an exceptional job of supporting the bank's growth and profitability conditioned upon her proper safety and soundness parameters. Lori has been a strong proponent of independent community banking and active member of our local community. Congratulations and best wishes in retirement were extended to Lori. Related to Ms. Hilger's retirement, President Perman announced the hiring of Mr. Doug Persich as the bank's Chief Financial Officer. Mr. Persich joined the bank in January. Doug is a graduate of University of Wisconsin-Madison, Graduate School of Banking in Madison, and certified public accountant. Mr. Persich has been in banking for 15 plus years, the last 6 years as CFO at a Wisconsin community bank. We welcome Doug to Forte Bank. The next order of business is voting on the directors in nomination. Chairman Prishkin reported to shareholders that the corporation's board of directors placed into nomination the following Class 2 directors: Mark J. Hauser, Timothy G. Perman, and Kenneth D. Reiser. No other nominations for director have been received in accordance with the corporation's bylaws, and as such, nominations for director have been closed. If so elected, the nominees would serve until the corporation's annual meeting in 2025. Chairman Prishkin then appointed Kathy Ingalls and Timothy Perman to serve as ballot clerks. Chairman Prishkin informed the shareholders as to the following. Shareholders who returned a proxy may either vote as directed in their proxy or cast a paper ballot at today's meeting. Shareholders in attendance who have not returned a proxy should have received a ballot upon registration and were asked to cast their ballot and present those to one of the ballot clerks at this time. Voting will remain open until 3 p.m. Central Standard Time to accommodate those shareholders attending via online webinar. Chairman Prishkin thanks the bank staff and the board of directors for an excellent year. She highlighted the bank's continued growth and improved profitability. Chairman Prishkin acknowledged and thanked Thomas Mackey, who retired from the board in April of 2021. Tom served on various committees, including the bank's Directors Loan Committee, Audit Committee, and Facilities Committee. Tom has added greatly to the success of the bank and has been a staunch supporter of community banking. Chairman Prishkin announced the appointment of Mr. Craig Wolf to fill the remaining unexpired term of Mr. Mackey. Mr. Wolf is president and co-owner of E.H. Wolf & Sons, Inc. in Slinger, Wisconsin. Craig is a continually active professional serving on various petroleum industry organizations and boards. Additionally, Craig is very involved in community, serving on Village of Slinger boards, a volunteer firefighter, and active member of his local church. We welcome Craig to the board of directors and are confident that he will continue to contribute to our ongoing success. Chairman Prishkin reported the initial voting results as follows. To elect the Class 2 directors. A, vote for the 3 nominees, 346,421. B, withholding authority to vote for the 3 nominees, 11,600. C, withholding authority to vote for individual nominees, 365. Chairman Rochelle R. Prishkin recognized that the 3 nominees have received a sufficient number of votes in favor of their election as directors of the corporation and declared them duly elected, subject to the 3 p.m. closure for all voting and confirmation by the corporation secretary. Kenneth Reiser made a motion for the same proxy arrangement for the next annual meeting. Mark Hauser seconded the motion. Motion carried. No other business was had. There being no further business, Chairman Prishkin concluded the in-person meeting at 10:54 a.m. The annual meeting will automatically adjourn at 3 p.m. this afternoon. Final shareholder roll call and director voting results. Shareholders voting in person, 2,100. Shareholders represented by proxy, 356,286. Shareholders absent, 77,566, for a total of 435,952. To elect the Class 2 directors, voting for the three nominees, present 2,100, proxy 344,321, for a total of 346,421. Withholding authority to vote for the three nominees, present 0, by proxy 11,600, for a total of 11,600. Withholding authority to vote for individual nominees, present 0, proxy 365, for a total of 365.
Thank you. Doug. So are there any corrections or additions to the minutes as read? With there being none, I ask for a motion to approve the minutes. Motion by Mark Lindberg, seconded by Mark Hauser. All in favor? Opposed? Carried. Now we will have the presentation of the 2023, financial reports.
Well, as of 2022.
Yeah. 2022. There you go.
All right, so yeah, I'm just gonna go over a quick review of 2022, just balance sheet and income statement and where we all ended up. So starting with the balance sheet, you can see we had phenomenal loan growth again at just under 19%. I think 2021, we were a little over 20%, so continued good growth there. But we did see some runoff, so you can see, so Fed funds sold, so what we have on hand extra money that went down percentage wise by a lot. Investments went down a little because we were trying to run off a little bit so we could have some more funds to fund our loan growth. And then we did have to take up some borrowings, as you can see down below, added about 8 million in there. Deposits were up, just not as much as the year before. So we just basically had to use other avenues to fund our robust loan growth. Interest income, so you can see investments that was up, even though our investment portfolio overall was down. We were able to reprice things higher as the year went on and the interest rates increased. And we also had money in Fed funds sold, so that was earning 25 basis points at the beginning of the year and all through 2021. And as rates increased, we were able to capitalize on that. Similarly with loans, you can see we had a 16% increase in 2022. And that's basically us able to capitalize on the increased rates. So we were able to get higher rates on our loans, and the variable rate loans were resetting at higher rates, and makes it even more impressive because in the 2021 figure, we had for PPP, we had over 809,000, I believe, in fee income from PPP and interest income. And that was about 191,000 in 2022 because we basically had all of our loans forgiven by mid 2022. So that stream of income went away. So it was even more a testament to the margin that we were able to maintain with the higher loan rates. So thank you. Interest expense, conversely, we were able to, like I said, we were able to capitalize on the income side with the higher rates. We did have a little more pressure for raising deposit rates as well. So you can see deposit interest expense increased similar with our interest on borrowings. We did increase our borrowings, and some we renewed at higher rates. So that also contributed to the increase in interest expense from 21 to 22. Provision, so we wanted to reserve a little more because we didn't know where the economy was going to go and if there would be any pockets of softness in our credit portfolio. So we did increase that substantially from 21 to 22, but I can report happily that our credit quality remains strong. We had 0 charge-offs, so that was just really to bolster our reserves. So we're in a stronger spot now after we're in the 22 than we were in 21. Non-interest income, basically the big one here. If you look at the third one down, the gain on sale of loans to the secondary market. So that's all of our residential loans that we can sell to Fannie Mae. And in 21 and start of 22, it was pretty crazy as the rates were so low. People were refining and it was just a really robust market, but that pretty much fell off a cliff as the Fed raised rates and that everyone kind of paused on what they were doing. So that's a huge hole that we had from 21 to 22. Ready? Non-interest expense, we did see some increase in salary and benefits. We did it, you know, there's labor supply shortage, there's inflation, so we had merit increases and just overall increases there, increases in cost of insurance. Unfortunately, we're not immune to that, and I know a lot of different companies had to face that in 22 and here in 23. FDIC insurance expense, so that's gone up a little bit as our deposit base has increased, so our assessed value on that is increased. So that's why that was up a little bit. That's good. So after it all goes through the wash, where did we end up? We ended up at about 3.2 million in net income. You can see the taxes are a little higher. We did in 22, even though we had less income, and that was due to some insurance policies that we did cash in because they were at below market rates, and we felt it was a better time to capitalize, put in those funds elsewhere, but then we had to pay the tax effect of that. So we're at 3.2 million, a little lower than 21, but given where we started the year and how we budgeted for the year and how it all ended up, it was a totally different story. So I am proud to say we did end up, I think our budget was a little over 3.1 million for the year. So after it was all said and done, we were able to exceed budget, but probably not for the reasons we thought going into planning the budget for 2022. So that's really all I had. So I just appreciate your time and your support.
Thank you, Doug. We will now have the 2022 management report by Tim Herman, President and CEO.
Thank you, Rochelle. I'll let my slides get loaded up here first before I begin. I'll say that there are 4 areas that I want to talk about this evening. And so I've gone through this a couple of times and we'll see where the time ends up, but I certainly want to allow time for questions at the end too. But 4 things I really want to hit on this evening. One is the continuation of the historical performance of the bank looking back 5 years. Second will be a discussion of some recent, obviously current topics that are going on in the financial industry. Third will be the second measure that is on the ballot for this evening, which is an increase in authorized shares outstanding. And then finally, just take a look at 2023 objectives for the organization. So the first few slides I'm going to go through again just relate to the performance of the bank. You can see last year we had about an 18.9% increase in loans and about a 6.3% increase in deposits. I did add to this tier 1 leverage ratio, so that's been fairly consistent. Where the leverage ratio at 10.12 increased over the last couple of years, and that's a good sign of the movement of strength as well too. So the lines represent, a 2-year average of growth, and you can see our loan growth has been exceptional over the last three years. Deposit growth had been maintaining itself. We saw a little bit of decline, but the previous 2 years were just excellent, out of the bounds of normal deposit growth. Now, the next slide that I want to share with you has to do with asset quality. This is a comparison of past due and non-accrual credits, what we classify as special mention, substandard, which are non-performing loans, and doubtful credits. Again, these numbers continued, as Doug indicated, to be exceptional. We've been declining in our substandard credits, and both our past dues and special mention have been declining. Past due and non-accruals and substandards have been declining or staying stable. And doubtful is almost non-existent right now. So asset quality remains very, very strong, not only here, but throughout the entire banking industry. The next slide is continuation of review of asset quality. So this is non-performing assets to total assets. We are the purple down in the bottom. The yellow or greenish yellow is the peer group, which is banks similar in size and located in a metropolitan area. You can see that we start out low. We've had very good performance on non-performing loans. The industry's been higher, but it's been improving. We're again almost non-existent in non-performing credit right now at this time. The next slide is net charge-offs to average loans. Again, we're the purple, and the yellowish green is the peer group of the banks, similar to Forte Bank. For the last 4 years in a row, we've had actually recoveries that exceeded charge-offs. So that's been an excellent run of performance within our loan portfolio as well. I'm going to switch gears to off of asset quality and more to overall financial performance. This is the return on average assets for the bank. Again, we're the purple. The greenish yellow is our peer group. We did decline a little bit last year compared to peer group, but again, this is a really nice return on average assets. You know, our goal is to hang around that 1%. We were just shy of that. Community banks performed a little bit less overall last year, and you can see that our peer group was down from the previous year as well, but we were a little bit below that. A good analysis of this is that where was the differential between us and our peer group? It was on two different points. One is we're beating our peer group as it relates to net interest margin, the differential between what we earn on loans versus what our interest expense is. However, our net overhead expense is higher by about 27 basis points than our peer group. And when you net the two of them out, that represents about the difference of what you see here between us and our peer group right now. The next slide is just us. This is Forte Bank return on equity. Last year we were at 9.72. Again, a very respectable return given the challenges that we faced last year, I think, as it relates to loss of fee income, particularly from secondary market sales. Next slide is earnings per share. We held fairly consistent above the $7 mark at $7.34 compared to $7.94. And overall, this number has been improving for our bank. The next slide has to do with stock valuation. So the green represents our book value. The purple represents our market value. And then I've added kind of like a trend line here. So as you can see, and is historical, we have our stock appraised at the end of each year. Whiffley Accounting does that for us. Our stock value as of December 31st of last year was $93 per share. It's an increase of $7 per share over the previous year, which was at $86 per share. One thing I'd like to note in here, and this is reflective in that line that is drawn in above the bar graph, and that is the appraised value to book value multiple remained consistent from 2021. Shareholders are based on the appraisal being priced at your stock at about 1.2 times book. And I have quite a deliberation with our appraiser just to make sure that, you know, I think they're fair from both a buyer and seller standpoint. So what would this, you know, as a comparison, you know, I feel and actually our appraiser as well feels that shareholders in a community bank should get some of the value above the book value that pertains to what is going on in the market with regards to whole bank sales. I'll share with you that the average median multiple of whole bank shares last year was 1.53 times book. So what the differential here is that the value that we're quoting here, the value that the appraisal is coming in at is indicative of the fact that these are minority shares. So, you know, what is a fair value for each one of you as a shareholder? If you wanted to buy or sell stock, you would not get the full multiple or the full values if the entire organization were sold. So, you know, I feel like in the conversations that I've had with our appraiser, that the approach to valuing stock has been consistent and it's been very fair from both a buyer and seller standpoint. I also want to, I don't have information on this, but as it relates to the market for community bank sales and stock is a trend that's changing and I think this will be a little bit of a deterrent to future M&A, at least short term, will be is that the methodology of sale has moved from a combination of cash and stock in the trade to more cash. That means buyers have to raise more money in order to do a purchase, and they can't give the value of their inherent stock as an exchange for the value of their stock. So I think that's going to be indicative of stock pricing going forward. And again, I think it may have the effect of deterring a little bit of what's going on in the M&A market, at least for the next couple of years. That's my guess. I'm going to shift topics off of our performance a little bit now and go into the segment that I referenced as what's going on in the banking world today. As I'm sure you're all aware, there were two banks that failed a little over a week ago, Silicon Valley Bank and Signature Bank. A little bit of discussion about what I've learned about those two banks. And this is, I mean, this same information I'm going to share with you is available to you. What I get is what's available, you know, out on the marketplace. More will be learned as time goes on, but I think there's a couple of things that are really indicative of what was going on in these banks that preempted their situation. First of all, as it relates to Silicon Valley Bank, this is a bank that we call in the industry a boutique bank. It specialized in certain segments of business, predominantly the tech and healthcare industries. They saw extremely excessive growth over the last several years. A large portion of their deposit base were venture capital companies, because venture capital is very much aligned with the development of software and technology development companies, as well as institutional depositors, again, closely associated with technology and technology startups. They had significant concentrations both in the deposit side and the loan side, because they're a boutique bank and they're lending predominantly to several different industries. That creates an inherent concentration to the bank, and creates a lack of diversity within their lending practices. They also, with the increase in the deposits that they had over the last couple of years, they invested large amounts into longer term securities. As interest rates rose, those securities became less. The size of organization that they are required them to post those losses, which are a direct charge against capital and earnings. I think a little bit less is known about the Signature Bank failure. However, this is a bank that in 2018 they began to accept or manage, along with regular US currency, cryptocurrency. They brought in a lot of depositors that were interested in cryptocurrency as a form of money exchange. The cryptocurrency market took a hit last year pretty significantly, impacted those depositors. Those depositors' cash needs began to increase. And again, concentrations on the deposit side to large, I'll call them institutional depositors, created fairly large exposures, atypical to the majority of banks. What's the differential between these banks and Forte Bank? Forte Bank garners its deposits locally, Washington County, southeastern Wisconsin. We do our lending locally, predominantly Washington County, southeastern Wisconsin. We do online banking, but we also do not do online account opening. Therefore, we are not garnering deposits from all over the United States. Many of these banks do. They have customers all over the United States. we're a relationship bank. It's hard to maintain those relationships and give confidence to a shareholder base, a depositor base, and a loan base when you're not in contact with them every day and they can't see you every day. That's a huge difference, I think, in providing stability and strength and confidence in the customer base that we have. I put together this little chart of information as it relates to what were the exposures of these banks to large depositors, as well as Forte Bank. So Silicon Valley Bank had $164.7 billion in deposits that were over the $250,000 FDIC insurance limit. That was 93.8% of their total deposits. Signature Bank had $79 billion in deposits over the FDIC limit. That was 90% of their deposit base. Overall, the entire industry, the last information that I have from call report data indicates that the entire banking industry has $9.2 trillion over the FDIC insured limit. That's approximately 43% of all deposits that are out there in the banking industry. By comparison, as of last week, Forte Bank had $44 million in balances over the FDIC insurance limit, which was 15.2% of our total deposits. And I think that 15 to 20% range is pretty indicative of the community bank market. So again, this is, I want to share with you the differential between what goes on in the community bank market and what goes on in some of these larger regional and mega bank environments. So, we're not beholden to larger deposits. Obviously, we want to retain all of our customers. These are, that 44 million is a conglomeration of business deposit accounts as well as individual deposit accounts. It's not unheard of to have deposits for business related companies that are well over the FDIC limit, but again, we hang our hat on the fact that we are a local relationship bank. And we feel confident that the way we manage and run Forte Bank gives confidence to our depositors. The next slide I put together relates to just giving you an idea of what is the liquidity, what is available to Forte Bank, particularly as it relates to servicing the deposit needs of our customers. This is beyond our daily operating funds, but this goes to our liquidity management plan. And I've just tallied these together. Unsecured lines of credits, which are essentially the line of credit that we have with our correspondent bank for overnight funds, as well as broker deposits. And these are not this is not necessarily the limitation that we have. These are self-imposed limits that we put on ourselves to ensure that we have adequate liquidity and we don't get ourselves out of bounds. The balance of that 26 million, 17 million would be what we have put on ourselves as an ability to take in what we call broker deposits. Our securities portfolio is 37.3 million. I want to take a step back. We have advanced about 8.3 million. This is as of actually the end of the year. That was the balance that was the balance on Fed funds that we had purchased as well as broker deposits. So we have about 17.6 million available. Our securities portfolio was 37.3. We have 3.8 million of that pledged predominantly to municipalities for municipal deposits, leaving about $33.4 million in available securities to be pledged. We do have a borrowing arrangement with the Federal Home Loan Bank of Chicago. We have currently pledged 1 to 4 family and multifamily mortgages as collateral for this. Our self-imposed limit is 15% of total assets. That amounts to 81 million. We borrowed about 17 million against that line, leaving us about $64 million. Also, as a last resort, we have the Fed discount window of about 10 million. And this has absolutely nothing to do with the recent program that the Fed came out with. We have not even analyzed whether that is an appropriate liquidity source for us to be involved with at this time, but it is available to all banks we know at this time and will be for a year. So all being said, our total borrowing capacity is 153 million. We have 29 million outstanding against that, leaving about $125 million of available liquidity to get at. Our borrowing capacity as a percentage of assets is 44%. We got 8.4 outstanding, leaving 35.9% in available borrowings. Our liquidity target is 30% internally. That's a self-imposed asset liability and liquidity management tool, and we're at 34.36%. So we have adequate resources of liquidity to meet needs in today's environment, I believe. The next segment I want to talk about is the bank's capital. This is a measurement of Forte Bank capital to risk-weighted assets. Our total capital ratio is 12.5% as of the end of the year. Our tier 1 capital ratio was 11.5, common equity tier was 11.5, and our tier 1 leverage ratio was 10.12. By regulatory standards, in order to be considered very well capitalized, you have to exceed 10%, 8%, 6.5%, and 5%, respectively, for each one of those categories. In all measures, the capital of Forte Bank exceeds the minimum requirements established to be considered well capitalized, and we exceed those. As such, Forte Bank has no restrictions on its normal payment of dividends, normal payment of incentive plans, anything like that. We have full capital access. Well, these three things, I think, paint the picture, and I want to share with you that I think the liquidity position of the bank, the backup liquidity position of the bank, as well as our reliance on large deposits and our capital structure, remain consistent with our practices historically, and Forte Bank remains a very safe and sound organization. I'm going to switch now to my third topic, and that is the stock capital overview and capital stock of the bank. And this will relate to the authority that you are granting us to this evening, or we are hoping to be granted to extend our authorized shares. So just as a review of our capital from a shares number standpoint, we are currently authorized at 1 million shares, $1 par value. Our shares outstanding are 580,284. I'm sorry, shares issued, shares outstanding are 435,952, and treasury shares are 144,332. The next slide has to do with what is the value of that. Common stock is booked at 580,284. These are all reflective in the statements that you got as of the end of the year. Surplus is 1,843,572. Retained earnings 36,727,300. The value of treasury stock, or I should say the cost to repurchase the treasury stock that we have on hand, was 5,393,546 for a net equity position of 33,758,610. Another, I think, important thing I would share with you as it relates to the holding company balance sheet is that the holding company has an established line of credit with our correspondent bank. That is up to $7 million available credit for us. It can be used and has been used for funding general operating support of the bank by downstreaming funds through the holding company to the bank. And again, helping maintain capital ratios at a very strong level and coinciding with the level of growth that we have had. We currently have $2 million outstanding on that line of credit. So we have a nice portion of that remaining available to us if needed. Next several slides pertain to potential activities that would give rise to the need for increasing authorized shares. I want to highlight as I go through these that none of the points of discussion I'm sharing with you tonight are formal in action. There's been no formal activity taken by the board on any of these. They are just under consideration for potential use in the going forward. So when I share some of these things, I don't want you to necessarily expect it because it may not happen. It's up to discretion and appropriateness of whether the board will act on any of these particular topics. The first one I want to talk about is stock splits. It's been historical that when our stock approaches $100 per share, we have done a split. Not always, but it's happened historically a number of times. So again, I'm not saying that that's going to happen, but the authorization under the resolution would provide the bank with the opportunity to do that if we deemed it was appropriate to do that. We're currently, as I just noted, at $93 a share on our appraised value, assuming that, profitability and performance of the bank continues in the direction it's had. It's plausible to say that our stock price could be at $100 per share in the next year or two. So would that give rise to a stock split? It could, and the authorization that we are seeking would allow that to happen. So, if we were to do, as an example, what we've historically done, a 2-for-1 split, that would require 1,161,000 shares. To do that, we'd currently be 161,000 shares short. And that number comes up with as you split all shares. You split the shares that are outstanding as well as the shares that are in treasury. So that's how we come to that number. A second possible thing that we've been looking at, and this has been requested by shareholders recently, and we're giving some consideration to it, is what's called a DRIP program, dividend reinvestment. Some shareholders say, I'd like to increase the holdings that are my position in the bank from a stock standpoint. I really don't need the cash revenue. I don't need the dividend income right now. Could you put together a plan where you would take my dividends and go and reinvest them in additional shares? We think that's a good thing, possibly. What would it do? Number one is increase the capital position of the bank. That's good for all of us. Number two, it would increase the retained cash by not having to pay out cash dividends, and it would provide enhanced liquidity for future growth. So we're evaluating whether or not a DRIP program is appropriate for the bank, and for those that have asked the question. I think it's a great question and one that we'll continue to evaluate. The final component to this would be, and I apologize, rather than stock raise, I should have entitled this capital raise. But is it appropriate for a capital raise, and why would we do a capital raise? I think a couple of reasons that may be appropriate is, as I mentioned, the $2 million that we have outstanding on our line of credit. Capital could be reused to pay that down to zero. Get the interest expense of that down to zero, basically. Free up that $7 million for future use. We are also evaluating expansion within the organization by branching. We believe we have a very well recognized and respected brand here at Forte Bank. We've been exploring the possibility of expanding our footprint, both here in Washington County and nearby counties. We currently own and are in the process of acquiring property for potential branching opportunities. The land cost is actually one of the least acquisition costs to operating a new branch. It's estimated that deploying a branch just from a building, facilities, equipment is about $3.5 million today. If we were to deploy a branch or two branches, that could be anywhere from $3 to $7 million. Is that an appropriate purpose for going out and doing a capital raise? Possibly. Again, it depends on what the market is that we're moving into. Do we mesh with that market well with our products and services and our mentality? And is the climate right? So no commitments have been made. We're exploring. And so that might be a possible reason for, again, doing a capital raise. as well as just continued organic growth and future expansion. We've grown tremendously over the last 3 to 5 years. We'd like to see if we can keep that going. Does that mean a greater capital base? It could. And so again, nothing formal here, but the 3 things that I mentioned are all part of the equation of why would we consider an increase in authorized shares. Those shares, the action that we put on the ballot for tonight actually does not commit the bank to anything. It does not change the shareholder value. It does not diminish shareholder value. It is just putting that tool up on the shelf to be available to us if the opportunities are appropriate and the timing's right for it. So those are my comments as it relates to the authorization to increase shares. I'm going to switch now to talking a little bit about 2023 objectives. This was a little bit of a challenge for our organization to start budgeting this coming year because we've had such good growth over the last couple of years, and we had to really take a step back and say, all right, we need to really be conscious of what we think is going on in the financial market, what's been happening with interest rates, what are the impact of that going to be? So we took a really measured approach to that, and that measured approach resulted in what I'm going to share with you here, and that is core deposit growth. We pegged at about 3%. We're going to take a balanced approach. As you know, today, CD specials are the name of the game in deposits. That has a two-edged sword to it. One is, are you pricing at a point where the market may move against you? As you may have heard today, Chairman Powell's comments are is he may have reached, or the Federal Open Market Committee may have reached the top of the rate increasing cycle. And there's some thoughts that towards the end of the year, depending upon what goes on with financial performance data, is that we could be seeing a decrease in rates. Now, that's not a given. I'm just telling you there's sources out there on both sides of that fence. So bottom line is we don't know. So when you go out there and you start offering long-term CD rates at high prices, you might be stuck with them for a long time. So we got to be very cautious about that. At the same time, we know we have to be competitive. And we want a complete relationship with our customers. So we're trying to make sure that we are developing that full relationship to ensure that do we have a checking account? Do we have a savings account? Do we have a business loan account with that customer? So we want the entire relationship. We just don't want CDs. So it's a balanced approach. On the loan side, with the increase in interest rates that took place at the end of last year and again forward into the first quarter of this year, we have seen a precipitous drop in loan activity. That's both across the board. It's retail and it's consumer or commercial. We don't think the type of robust growth that we've seen the last 3 years will be available this year. So we've tempered that and said that if we can get 3% loan growth, we think we'll be in a good position. We also are conscious of off-balance sheet obligations that we have. That would be construction loans. We want to make sure that we're in a good position to substantially complete those and fund those construction loans and move them into permanent financing. And I think all this said, our emphasis is going to be on making sure that we are supportive of our current customer base at the highest level that we can. Obviously, liquidity management is paramount. Again, I already talked about this. We want to reduce our off-balance sheet commitments. That's by finalizing construction loans and line of credit exposures. We're going to be finishing out construction loans that we've made commitments on. I can tell you that there are not a lot of construction, at least on the commercial side, which are big dollar loans that are coming to us right now as opportunities. That market is just kind of going silent right now. So overall, I don't anticipate a robust year in terms of loan growth. Also, while all this is going on, we have to continue to be conscious of the security of deposits within the bank from fraud. We are going to be implementing a couple of programs this year to help support fraud and cybersecurity risk mitigation. The first one will be a product called Secure Now. That's an enhancement to online banking, user code and password. It's multi-factor authentication. Again, the customer gets a code sent to them, and that they input that code, and that confirms that they are the right person to have access to that. Expect that to come out summer of this year. Likewise, we'll be implementing a product called Positive Pay. There's been just a rash of situations where corporate checks have fraudulently been created, run through the system, they get to the bank and they're paid. And once they're paid and they're determined that they're fraudulent checks after that, it's just really hard to collect on that. Positive Pay is where the customer creates a file, sends it to us of all the checks that they've issued and dollar amount. And we compare that file against the checks that are coming in. And if it matches up, the checks get paid. And if they don't match up, the checks don't get paid. So again, it's just a prevention against risk of loss to the bank. We've seen a couple of fairly large dollar transaction or accounts that have been had this happen. And, we don't want that happening to customers, and we don't want to incur the risk of that and the loss of it as well. So this is a product that we think will be pretty important on the business side. I'll tell you that the dilemma is, will customers pay for it? The offset to not paying for it will be is that customers will be signing an indemnity agreement, which says is that if they agree not to take this product and checks come back fraudulent against their account, they are held liable for them. The bank has no responsibility. So Positive Pay is not a free product. It will have a cost associated with it, but the cost of that is pretty cheap insurance against what's going on in the market today. Further, internally, we are continuing to work on and enhancing what's called user rights assignment. That's ensuring that only employees that are doing certain things have rights to certain pieces of information or systems within the company. We continue to advance that. This has been a work that's been going on within the bank, as well as network segmentation. What that does is it isolates certain parts of programs that we utilize, that if somebody were to get into the bank, they can't get into the entire system of the bank. They would get closed down into a small portion of the bank. That way, all of our data and all of our information is not subject to a possible breach. So all these things are pretty much being mandated, actually, by insurance companies and by examiners for the protection of all depositors. Those are, I think, the main topics of what Forte Bank is going to be focused on in 2023. Our core value statement is up here. It has not changed. We intend to be a community bank going forward, fundamentally sound and strong. The tenets of being a strong bank are great customer service, honesty and integrity in everything that we do, having a team that's unified and working to the benefit of customers, profitability, but with safe and sound management, and a committed corporate citizen to the communities that we serve. That's the conclusion of my comments for this evening, and I would welcome any questions that you have from the floor or those that might be coming in online. Any questions? Sorry if I was too long-winded. Jen, any questions coming in from?
Oh, I got one. The question is, where is Forte Bank on the interest rate it pays on deposits, which generally impacts the outflow of funds if the interest rate is not competitive? That's the first part of the question. And then how do these rates affect the $40 million of funds over the $250,000 FDIC limit?
That's a great question. I would say, well, I'll break it down into the different categories of deposits. So I will say on money market or on now accounts and savings accounts, we are in the middle range as far as rates being paid. On money markets, we just raised those. We are in the market as it relates to local competition. We know that there's competition from national money market organizations.
And that's pretty stiff. I mean, those money market rates are in the 4% right now. On the CD end of the spectrum, I think our CD rates are very competitive to the local peer group. We do have to be concerned with where our rates are at. I think the latest increase that the Fed just announced today will prompt some increase in rates overall. The $44 million that I noted are they're across the spectrum. They're in savings accounts, they're in checking accounts. Some of them are in non-interest checking accounts. Some of them are in money market accounts. Very few of them are actually in certificates of deposit. So, yeah, we are concerned about it and we are watching it. We have a regular ALCO asset liability committee meeting where we assess our rates as it relates to the market locally as well as nationally and who we're competing against. The same token, we have to balance how fast we raise interest rates because we want to maintain our margin. That's part of our profitability. So it's a balancing act right now, to say the least.
Another question. And forgive me if I'm interpreting this wrong because it's abbreviated NI. Any willingness to share budgeted net income? I believe is what he's asking for 2023.
It's budgeted net income is very consistent with 2022, around that $3 million mark. Great question. Any other questions? All right, very, very good. Thank you. I appreciate your time.
Thank you, Tim. So we will move into the matters to be voted upon. First item, election of Class 3 directors. Corporation directors are elected on a classified basis, with the corporation having 3 classes of directors. Directors are elected to serve for 3-year terms or shorter if the director was elected or appointed to fill a vacancy. The bank's 3 classes of directors are elected and serve on staggered terms. The following individuals have been placed into nomination by the board of directors to serve as Class 3 directors. If elected, their terms would expire on the annual meeting of the corporation in 2026. Alan A. Loffer, Dr. Mark Limborg, Craig S. Wolf. In accordance with provisions outlined within the corporation's bylaws for the election of directors, no other nominations for director have been received. As such, I will declare that the nominations for directors have been closed and the individuals so named will be those for whom voting will take place. Second item to be voted upon is amendments to articles of incorporation to increase the number of authorized shares of common stock from 1 million shares to 2 million shares. So I will appoint Kathy Ingalls and Doug Persich as ballot clerks. So the key point for shareholder voting: if you prepared and returned a proxy, you may allow your proxy to stand and shares will be cast as directed in the proxy. Shareholders present who have not submitted a proxy or those wishing to cast a paper ballot and revoke your proxy should have received the ballot at the registration table when you arrived this evening. Those shareholders attending online via Zoom webinar may cast a paper ballot by representing or requesting a ballot from either Tim Perman or Doug Persich, CFO. You may contact Tim Perman at 262-224-4965 or Doug Persich by calling 262-670-3874. Please ask to speak to Doug or Tim directly. All ballots should be returned via the following fax number: 262-670-2226. Voting will remain open until 10 p.m. Central Standard Time this evening. Again, any shareholders who submitted a proxy may vote by ballot. However, if you are doing so, you will be required to do so in accordance with the provisions outlined in the February 27th, 2023 letter to shareholders. Those provisions require the shareholder to contact one of the ballot clerks appointed for this meeting to receive a ballot and then submit the ballot via electronic means by the deadline. At this time, ballots may be cast and presented to one of the ballot clerks. So I believe there are some, so Doug or Kathy.
Well, that, if you were handed a ballot as you came in, go ahead and fill those out now.
Yeah. Technically, some larger.
You get everybody's paper ballot, that was handed one, ballot. Okay, bear with us for just a minute and we will tally that.
Just take a minute. We'll get that down.
Well, should I go on to this as their account? Or should I just wait?
I'm just back in curling, but just a minute.
Okay.
Something.
While we're tallying up ballots here, just a couple of things I'd like to share with you. Following our business portion of the meeting, you're all invited to join us upstairs for a little social hour. A few things that are going to be taking place up there that we'll make available to you is if you have questions about security or fraud prevention, Tony Andrick and Lisa Becker from the bank will be upstairs to answer questions as it relates to that topic. Tammy Tungasi from the bank here will be available to talk about Community Banking Month activities. As you know, April is Community Banking Month. We have a slate of things that we enjoy doing every April, and I know Tammy would be more than happy to share with you what we have lined up for this year. So please ask her about that. Also, a slate of events have been assembled as it relates to primetime account members. And Colleen Baus will be upstairs and we'll be happy to talk with you about the Primetime Club and what's on the docket for this year for that. Also, Kristen Strupp, Kristen's right here in the blue shirt. Kristen is a financial advisor here from Forte Bank Financial Advisors, and she'll be on hand upstairs to speak with anybody that might have questions with what's going on at Forte Financial Advisors in the investment world. Right, Kristen?
Absolutely.
Good. Very good. Don't know if they're all present, but it's been a while since we've been together as a group, and I think it would be a good opportunity to introduce the leadership team of the bank to you. You know, I think one of the biggest reasons why community banks continue to decline and don't exist is because they fail to provide for the future. And that's from a management standpoint. So I think we're very fortunate right now at Forte Bank to have a very good leadership team, one that's positioned for the future. And I think I'd like to take the opportunity, if I could, to introduce those members to you. First to my right, I'm going to ask you to stand up if I'm going to embarrass you guys and gals. Yeah, I'd love to have that happen. So first is Aaron Lensing. Aaron, would you please come forward? Aaron is the senior vice president of the bank. Why don't you come here, right here. So
You're on camera now.
Yeah. Aaron's responsible for business banking within the bank, and that's commercial lending. So we're happy to have Aaron as part of our team. Also, Jen Johnson. Jen, you need to come up here as well. I'll move over here. Jennifer Johnson is vice president, chief risk and operations officer for the bank. Josh Sandelback. Josh, would you come up? Josh is the bank's vice president and chief credit officer.
Lynette Voss, is Lynette? Lynette?
All right, I'll wait to introduce Lynette too then.
And Doug, you met Doug. Oh, here he is. Come on, back in, Doug. Happy to have Doug on board with us as our chief financial officer. And not joining us this evening, but we hired in end of September last year, Kathleen Slack. Kathleen is Vice President, Human Resources Manager. Kathleen has about 20 years experience in human resources. Joined us with her previous employer was Premier Bank in Fort Atkinson. She has about 5 years experience as it relates particularly to financial institutions in the human resources area. So we're happy to have Kathleen on board with us as well too. So aside from Lynette, I believe, and I think that's just it. Lynette, this is the bank's leadership team, and they do a great job for the bank. Thank you for coming.
Donuts tomorrow morning. You're bringing donuts?
And I would also be very, very remiss if I did not give accolades to the entire team here at Forte Bank. And as Doug read in the minutes, that was paramount in my comments last year, and it will be paramount again this year as well too, is that we are very fortunate to have a great group of employees that work here at Forte Bank. They are very dedicated individuals. They take very much to heart the individual, the customer, ensuring that the customer is treated well and that their needs are being met. And they very much embrace community banking. They like what Forte is about, and they are a big part of our success, the biggest part of our success. They are our greatest asset. So my compliments to everyone at Forte Bank. The employees are doing a great job here, and I applaud your efforts. Why don't you stand, please, if you would. And then one last thing, and Joyce, you can remain standing. Joyce, why don't you come up here?
Hot seat.
So Joyce has been with the bank a long time. I'm going to tell you, 49 years.
Wow.
Joyce, well, she's only 52, so when you start at 3, it creeps up on you. But Joyce has been with Forte Bank 49 years. Her entire career in banking has been here. Joyce started out, I believe, in deposit operations, did tellering, and then moved up to the loan processing side as well. And Joyce will be retiring in June. And so just compliment you, Joyce, on a great career here at Forte Bank, and your commitment to our bank and your support has been very essential. So nice job and congratulations.
Yeah.
The voting data for the election of directors. Votes for the 3 nominees present, 116. Proxy, 345,847, for a total of 345,963. Withhold authority to vote for the 3 nominees present, 0. Proxy, 3,000, total 3,000. Withhold authority to vote for individual nominees present, 0. Proxy, 1,700, total 1,700. Total shares voted, 350,663. Number of shares not voted, 5,031. So on the matter of the election of directors, I will recognize that the three nominees have received enough votes in favor of their election as directors of the corporation. I would declare them duly elected, subject the 10 p.m. Central Daylight Savings Time, closure for voting, and confirmation by the corporation secretary. Voting data to amend the articles of incorporation to provide for the increase in common stock from 1,000 or 1 million shares to 2 million shares. Present 116, proxy 322,539, total 322,655. Vote against amendment, present 0. Proxy 15,445, total 15,445. Abstain, present 0. Proxy 6,936, total 6,936. Total shares voted 345,036. Total shares not voted 10,658. On the matter of the amendment, I will recognize that the matter has received sufficient votes in favor and therefore will be considered ratified by the shareholders. Again, subject to the 10 p.m. closure for voting and confirmation by the corporation secretary. Now I ask for a motion for the same proxy arrangement for next year's annual meeting.
So moved.
Motion by Ken Reiser, seconded by Craig Wolf. All in favor? Opposed? Carried. And just a few words. As you have heard tonight, Forte Bank is doing well, and we are working to position ourselves for more growth opportunities in the future. With that all said, I would like to thank the entire board for the willingness and ability to commit their time and energy to the success of Forte Bank and remaining an independent community bank. I also would like to acknowledge the efforts of the entire Forte Bank team. All the hard work from all the departments in the bank have aided in the success we have had in the past year, and we remain focused on being the most highly recognized and respected bank in our market. I would like to assure everyone that Forte Bank remains sound and continues to be a safe and a secure place for your deposits. As a community bank, our business model is considerably different from the banks that have had recent failures. We gather deposits from our customers within our local markets and then lend those deposits back to both our local businesses to help support their operations and to local individuals to purchase homes, buy cars, or recreational vehicles, and etc. This type of banking activity leads to much lower overall risk profile for Forte Bank. Further, we are well capitalized, have sufficient liquidity availability to meet our operational needs, and have the best loan quality and highest loan reserves in years. We are well positioned for whatever economic headwinds come our way. Your deposits remain safe and secure with Forte Bank. So I ask if there's any final questions or comments tonight. Any, Jen? No. Having concluded all business to properly come before this annual meeting, we will end in-person and electronic activities. This meeting will automatically adjourn at 10 p.m. this evening. So we look forward to meeting with you all upstairs. Thank you.